Rethink Your Wealth is brought to you by UOB. UOB, right by you.
As we head into 2025, investors are keeping their eyes on a mix of familiar economic indicators: inflation, interest rates, and growth. According to the OECD, the global economy is projected to remain resilient despite significant challenges, with predictions for the year ahead being shaped by factors such as shifting policies, global trade tensions, as well as the impact of emerging technologies like AI. How should investors navigate risks and capitalize on opportunities? Well, for more insights, we're joined by a couple of guests. Abel Lim, Head of Wealth Management Advisory and Strategy at UOB. Abel, good morning.
Good morning. Thank you for having us.
Thank you for coming on. And he's joined by Heng Head of Market Strategy, Global Economics and Market Research at UOB. Good morning, Koon.
Good morning.
All right, Koon, let's start with you. Now, many things to look forward to, but also many uncertainties to tide through this year. Donald Trump's return to the White House, for example, is expected to entail a significant shift in domestic as well as foreign policies. What do you think are the key policy risks from Trump, and what should investors focus on the broader scale in relation to the risks versus opportunities that are presenting themselves right now?
Indeed. So we've had a very exciting, if I may say, volatile start to the year for financial markets. As you've seen, bond yields have crept much higher. US dollar is stronger. Markets are preparing and looking forward to all these uncertainties, as you say. This will be a year with a lot of policy changes. Now, whether it's more tax cuts from Mr. Trump in the United States, whether it's more restructuring and stimulus from China. And of course, the big one is the trade tariffs. They are incoming to China, to Canada, Mexico, and potentially quite a few other countries across the world. So I think investors need to be very wary of the volatility, of the stronger dollar, of the higher and stickier interest rates, and basically practice good risk management to manage all this risk.
All right, so a number of things to look out for if you're an investor. Abel, let's bring you into the conversation. What are some of the best and worst case scenarios, and what can investors do to ride out the increased volatility that we've talked about that will likely characterize financial markets over the next 4 years off the back of Trump's presidency?
Yes, so adding on to what Koon has just mentioned, we have painted about 3 scenarios of which how markets are likely to play out. The first one, obviously, is that Trump comes in with a more measured approach, not taking a direct hit to any country, but be strategic in nature. That way, markets are likely to be more calm, and as such, the rate path is likely to have the cuts. The worst case scenario, of course, is when Trump comes in all guns blazing with 60% tariffs on China, 10% universal tax. That's going to result in an all-out trade war. So obviously, that's not good for markets. Markets are going to react pretty badly. If you look at what happened in 2018, I think we saw what the markets are likely to present itself, and you're going to see pretty negative outcomes. Our base case, however, is that we will see probably a 25% tax tariffs on the Chinese economy and maybe 10% on countries with large imbalances. That way, we're probably going to see a cut or maybe none towards the end of this year, but it's going to be more moderated and likely to be less volatile than expected. Now, to mitigate some of these risks, clearly you want to diversify your assets.
Sure.
Diversification not only manages the downside risk, you allow yourself to be capturing upside potentials, being exposed to entities, countries, and even industries that actually will outperform during periods of high volatility.
Koon, we obviously can't talk about the U.S. without mentioning China. There's no secret there. What is UOB's outlook for those two economies? Should we expect to see some divergence on that front?
Well, there is already divergence as we speak. U.S. economy has done very well at the end of 24, and that strong momentum will carry through to 2025. We expect tax cuts again from Mr. Trump. The innovation, the strong capital flows into the United States will put its economy on a firm footing this year. And a lot of U.S. corporates are flush with cash in their balance sheet. So there's a lot of investment potential. Now, unfortunately for China, it is still going through a very painful economic restructuring. Growth is slowing down. We have downgraded China's GDP this year to just 4.3%. Clearly, there's a lot of pain going through the property sector. They need to pivot away from the old model, the old economic model of growth relating to property infrastructure development to new models, EVs, technology, and they need to look for new areas of growth outside of China. So this will take time, and basically this will weigh down on the economy over the short term. So for those of us here in Singapore, in ASEAN and the rest of Asia, we need to appreciate this divergence between the US and China.
All right, Abel, let's get your thoughts on this. What is UOB's outlook for US and Chinese stocks? Should investors stay invested in the US? Is it time to bottom fish in China, buy low, sell high, perhaps?
Okay, so United States companies are incredibly good at making money. And that's the reason why, if you use a sports analogy, okay, why are you paying top dollar for the likes of Cristiano Ronaldo or Lionel Messi? Because these people score goals. And this is the same reason why US valuations is lofty today. It's frothy, we recognize that. But there is a good reason behind it, because fundamentally, Trump's pro-growth policy is likely to be supportive for the US economy in the year going forward. Yes, we recognize that valuations are high, but this is in a very narrow case. Typically, we expect this to be broadening out across the US economy throughout the course of this year on the back of some of Trump's policy, which is highly supportive, for example, deregulations in the tech front, in the financial system, and also small cap companies which are more domestically driven. So we think that investing in the United States needs to be a little bit more picky in nature, but there are opportunity sets in that place. Ultimately, if you think about it, Trump's scorecard, his KPI, is really about the health of the US economy. So if his policy starts to hurt the economy and we start seeing the negative effect, he's not likely to continue to push very hard on his agenda for obvious reasons, because it's going to look very, very bad when the economy, or if the economy tanks.
Yeah, so one factor that plays a role in the health of the US economy is interest rates. So let's touch on interest rates. Do you share the view, Koon, how that interest rates will stay higher for longer, and what would that mean for regular Singaporeans?
Yes, so if you put it in context in 2024, sometime before the US presidential election last year, we were expecting maybe around 4 cuts this year, right? After Mr. Trump won the election, that was driven down to about 2 or 3 cuts. And now, given the worry, the concern about the tariffs that are incoming later this year, so we have now dropped the expectation of Fed cuts this year to just 1 cut. So to put it very, very candidly, there's a risk, that we agree that there may be no interest rates cuts coming this year from the Federal Reserve. In other words, yes, interest rates will be sticky. Interest rates may stay high. For investors who were looking forward to lower rates, to refinance their loans, to basically restructure their portfolios, I would say please be a bit more cautious. This is not the year to stick your neck out.
All right, so given that interest rates are likely to remain sticky, to remain high, at least for the foreseeable future, Abel, what can Singapore investors do to mitigate against these rates?
So here's the good news. It's not all doom and gloom. Okay, with rates staying higher for longer, there are certain asset classes that actually tend to outperform in a higher rate environment. 2 asset class sticks out. The first one is investment-grade bonds. Okay, high-quality issuers who are paying very handsome coupon rates to investors. So yes, in the earlier bits, rates has come off a little bit. But I think with the higher rate environment, we are likely to see investors continue to clip very high coupons. Coupons that were formerly high yield in nature, but you're getting very good issuers. And we expect rate path to gradually grind down over the years. With that, you see capital gains in investment-grade bonds. Similarly, we also like Asian quality companies that are paying high dividends. Companies that are well-run, good cash flow, high ROI. This company tends to perform better during volatile times and continue to pay very handsome dividends in this process. So these 2 asset classes tend to stick out quite nicely for us during high-rate environments.
So if I may add to Abel, one thing when I speak to investors as well is the need to diversify, the need to lower volatility for the portfolio. And I think gold sticks out very, very well in this environment. In fact, it has been climbing despite higher interest rates, despite stronger US dollar. So we want to reiterate that gold remains a very good investment to have in your portfolio to diversify our risks, and we remain positive that gold may climb further towards around $3,000 per ounce by the end of this year.
Okay, so there is a silver lining in all this, in that, there are options aplenty, it seems, for local investors. Now, it's a big year here in Singapore. It's election year. So aside from, all the factors that you guys have mentioned, are there any specific developments investors should keep in mind as they navigate 2025? Koon, I'll come to you.
So this year is election year. This year is SG60.
Yes.
Of course, we can expect more CDC vouchers. We can expect more skills futures credit. But jokes aside, right? I think this is a year where we are going to see more developments, more cooperation between Singapore and our region as well. So we just signed the agreement for the Johor Singapore SEZ. All of us are looking forward to new initiatives of growth across the causeway. We as consumers are looking forward to the RTS next year. And of course, broader, I think the whole ASEAN community knows that the trade tariffs are coming. We need to work together to improve our regional cooperation, regional trade. So I think everything is very like-minded. We are looking forward to more exciting initiatives to support the region this year and in the coming few years.
Fantastic. Abel, anything you'd like to add on to that?
Yes, well, actually, Singapore is quite well situated. Singapore is not insulated from the trade wars for obvious reasons. We are a very open economy. So what happens out there is going to impact our economy ultimately. However, we are actually quite positive on Singaporean equities. And the reasons are a few. Number one, Singapore consistently has a negative trade balance with the United States. That makes us not an immediate target on the tariff front, which is a good thing, and we have FTA as well. But importantly, on the valuation standpoint, Singaporean equities are actually below its 10-year average, which is actually quite attractive considering that we are one of the fundamentally stronger nations and economy in Southeast Asia. But last but not least, if you think about it, Singapore is a safe haven. When there's some of the volatilities in the market, you're likely to see attention moving into Singaporean equities and, highlighting that Singapore has got strong fundamentals, strong governance, and that gives people the comfort to invest in some of our equities on the Singaporean front.
All right. Well, gentlemen, it's been a pleasure having you on the show. Thank you so much for your time and insights today.
Pleasure's ours.
Thank you.
We were in conversation with Abel Lim, Head of Wealth Management Advisory and Strategy at UOB, and Heng Koon, Head of Market Strategy, Global Economics and Market Research at UOB, and they were talking about how investors should navigate risks and capitalize on opportunities in 2025. Stay with Money FM 89.3.
Money FM 89.3.